Everyone, welcome back to Red's Roundup. In this video, we're going to be looking at Landmark, a risk arbitrage situation. Okay, so first up, an overview of their assets and their business. So Landmark Infrastructure Partners is structured as a master limited partnership. That is a mouthful, but what that means is it's a special type of company that has special tax implications. It won't really be relevant for us right now, other than for why there's an opportunity. Okay, so the overview of the assets. They have four main asset classes. Just a brief overview here. I just pulled this right off of their slide. We have the data center, where they own the underlying property that the data center's on, and the infrastructure that the data center is within. So not the actual equipment or anything like that. And then they also own some billboards. So they'll own the land under the billboard, and then a billboard advertiser puts a billboard on the land, and then they pay rent to Landmark, and then the billboard advertiser rents out to advertisers. Oops. Then we have solar. They own a little bit of solar, pretty basic. They just own the land under the solar. And you'll see a connection here that they pretty much just own the land under things which get rented out to people, which is again the case with their main, most valuable asset class, which is the cell tower leases. So they own the land under cell towers, which the cell tower own, and it's a complicated mess, but it's a super valuable asset, basically a perpetual cash flow. Many of these leases are actual perpetual leases, meaning like last forever or into perpetuity. So they're very high quality assets. And as you might know, with 5G coming out and everything, these are going to be a really important part of digital infrastructure in the coming years. So that's how they have been positioned recently. I would say the primary motive behind buyers has been for these assets, the towers and the data center. Okay, so here's what the situation is. I've reviewed Landmark in the past, and at that time I said, I'm not really sure what's going on here. Doesn't seem all that special. I'm not sure I'm able to understand how this is a super valuable business. Well, it turns out I was probably wrong. And it was actually a viewer that recommended this to me, Landmark, in the past. So I said, I don't understand this. Well, it turns out I understand a lot better now, and people are willing to pay a heavy premium for the business and their assets underneath, frankly. So what happened? May 14th of 2021, Colony, they bought out the general partner, Landmark Dividend, from Landmark Infrastructure Partners. That's how MLPs work. There's a GP and an LP, general partner, limited partner. Limited partner gives them the money, general partner invests that money. So they bought out the general partner who makes the management decisions, and they were seeking to buy out all the other units, and they're called units, not shares, from the LPs, which would be a unit holder, at $13. So the stock was selling here. It went all the way up to there. And so it made up a big gap in that one day after that announcement. Then the announcement came, the stock fluctuated a little bit. And then on July 16th, 2021, Verde Asset Management, I think it is, bid at $13.50 per unit, which is up 50 cents from the Colony bid. So they thought these assets, hey, I'm not going to get cut under by Colony, because Verde, they were a longtime holder of Landmark. So they decided, you know what, we don't want to get taken out at less than intrinsic value. We know what this is worth. We're a hedge fund. Let's just bid more. So then they did. And then they bid more, and then the stock went up. It even went over $13.50 for a little bit, which is suspicious. And then it went back down after that. At which point, Melody Investment Advisors, I think it is, bid $16.25 on August the 4th, I think it was. It's either August 4th or August 2nd. And then it's shot way up and then it crashed back down a little bit. And I was actually purchasing shares in this range here, mostly around 1330 or 1430 was most of my purchase price. And that's what I've been doing the last week. I've pretty much been going most of the way in on this deal, and we'll see why, because the stock is not yet at 1625. It's only at 1450 about right now at the time of recording. And so that's actually a pretty big gain to be made from this special situation. So why do I think this is such a good situation? Buying now at like 1450 and hopefully getting bought out at 1625 or above. Well, because the offer from Melody is a really good offer. They know what these assets are worth. They specialize in these types of assets. And so they're going to be able to pinpoint a pretty close intrinsic value and be able to maximize the value from these assets. And let's just say they did put in like a false bid that they really didn't plan on actually purchasing the assets. Their reputation would be destroyed within this asset field. No one would want to sell to them ever again, and that would be a problem. So I view this bid as highly credible. So number 2, Colony has a fiduciary duty to unit holders to sell to the highest bidder. And as it stands right now, most of the unit holders, I think, would prefer a sale. It's been an underperforming stock, underperforming price, and generally the master limited partnership hasn't really benefited unit holders. And so this comes with it a reputational risk for Colony to get basically the best offer. There was even a letter from one of the shareholders saying that, hey, maybe here let's try and break up the assets and sell them individually. I thought that was pretty interesting, and I think we could even get a bid above 1625 if that is the case, if they can break up the assets. So next, third, we have, it's a very high return on risk. So what do I mean by that? I basically just mean upside divided by downside, and that's your return on risk. So if you're going to invest money into this situation, I'm taking that $13.50 bid. You could even take the $13 bid as your downside. And when you take that as your downside, it's not like a normal investment where you're taking your downside as basically zero. You're saying, okay, my downside's probably capped at around $13.50, maybe $13 if we're conservative, and my upside, let's just say, is $16.25. So it's actually a pretty good return on risk in relation to the money you're putting at risk. Okay, so next, potential for a bid above 1625. Excuse me. Both Melody and Verde both said that they, after a due diligence period, would be willing to possibly bid higher than their initial bid. So Melody, if they bid higher than 1625, that only increases our upside. And we could say, hey, maybe Verde is willing to spend more than $13.50 here. Maybe our downside is even $14. So that's a pretty interesting thing there. Next, it's pretty short-term in nature. So if you have an immediate cash preference, you're going to be able to have your cash from this deal, I would assume, within a year. Most mergers and acquisitions close within a year. So that's what I would be assuming here. And then this gives you added optionality after the deal to reinvest your money at a high rate of return. So next, bidding war. You really don't know what's going to happen in a bidding war. Things could get out of control and someone could bid $20 even. You really don't know. So there is a lot of uncertainty, but the uncertainty is to the upside. And if you've heard of Monish Pabrai, he talks about high uncertainty, low risk. This is a perfect example of that. We don't know what Landmark is going to sell for. Is it going to be $16.25? Is it going to be something else? That's uncertainty, but there's very low risk. And so I'm going to show you my model here about how I think about it. Okay, so I just thought I'd show you my model because I have been quite diligent in figuring out this situation because I do have a sizable majority of my portfolio in it now. So you can just see Landmark is the stock and current price. We have here my value, which comes from an expected value from right here. It'll make sense as we go on. And then my expected return. that takes a probability weighted approach. So we have here three options that I think could realistically happen. We have a higher bid than the Melody bid. We're going to say that's $17. The Melody buyout, which is $16.25, and then the low buyout from Verde at $13.50. So I'm saying this the higher bid would be a 17% return, Melody bid would be a 12% return, and the low buyout would be a negative 6% return. So I went through, and as I looked at this situation, I adjusted the probabilities of each event to reflect what I think is realistic. So I'm giving the probability of a higher bid than the Melody offer a 20% probability. Now, you could argue that no, there's probably not a high probability of that, and you could be right. You could just take this to zero. You can mess with this at will, and you get different values. But when it comes down to it, as you'll notice, basically you're always getting a pretty high expected return, especially if we look down here for your risk. So, and then for Melody, I said it's a 70% probability of that happening because I think the bid is credible, number one, and number two, I think Colony has the obligation to select that bid if it comes down to it. And the other option here, which we haven't talked about, is that Colony actually makes a higher bid themselves, which I don't rule out. And then the low buyout from Verde or Colony at $13.50, I'm giving that a 10% chance. I really don't think this Melody offer is going to fall through, and if it does, I think a higher offer will fill its place. And here we have the expected value. We just multiply the stock price given all these bids, the buyout price essentially, and then we multiply that by the probability to get an expected value, and then we add them all up to get my value, which is the expected value, for what I think it's worth. So I think right now I would pay $16.25 or less for Landmark. And right now, if you compute the expected return with the current price and my expected value, that's an 11.28% return. And we have the options over here, but I've actually found the options might not be the way to go because of this down here. You might see the expected return on the option is 72%. That seems really good. But when you compare that to the return on risk, it's not as good. So we have this little table here. We're going to say we're going to risk $1,000 to this deal. You could be somewhere else, say you want to risk more or less. This is just an example. We want to only risk $1,000. Okay, that means we can put up $1,000 for the option. And the option price is a $15 option, $15 strike, paying, let's say, 70 cents per option. And so if the stock ends at less than $15, we are going to be losing all of our money. But if it ends at above that, we're going to be making a profit. So with the stock, we can only lose 6%. So we can actually risk or put on the table a lot more money than we're actually risking in this situation. So let's say we're risking $1,000. We can buy $14,000 worth of stock, and we're only risking that much. And then our expected profit is $1,651, and the profit if Melody bid goes through is $1,777. So as you can see, that's a pretty good return on risk for the stock, and that's actually more than the option, which is important here because this is the type of situation where you can put in a lot of money and not worry very much. Well, that's not investment advice. I feel comfortable putting in a lot of money because I feel like I understand the risks. That's not investment advice. Let me say that again. Whereas with the option, you don't get that same return on risk. So if we were to just do what's your return divided by what you're risking here, it's much that's wrong. It's much higher for the stock is what I'm saying. So you're going to be making a substantial amount more, 1.17 times more return than you are going to be risking. So that's what I look at in this type of situation. Next up, we have a timetable for what I think could come next. So this one first here, I probably should have labeled this, but this was just for me. May 17th, Colony bottom out. July 16th, Verde offer comes. That was 60 days apart, approximately. And then August 4th, Melody submitted their offer, and that was 19 days later. So I'm just saying, if we go 19 days in the future, that would be August 23rd, we might see another offer. That's what I'm thinking. It could be anywhere between the 23rd or a month or so later. I think things are gonna be slow for the next couple weeks, but then after that we could see a big piece of news. Yeah, so I would say just keep your eyes out on this one. Let me know what you think. If you have any questions, if you see any flaws in my reasoning, please let me know. I would like to not lose money. So that's all for today.